Welcome, everyone. Thanks so much for joining me for this month's webinar. Today's topic is taxes, and much like everything else in our lives, it should come as no surprise that 2020 will be a little bit of a different tax reporting year than we're used to. We're also going to talk about how you can position yourself and your household for tax efficiency in the future. Just a couple of housekeeping items. We may not have time for a live Q&A today. Um, but thank you to those who have already sent in questions. I've included a couple of them at the end of the webinar, which I hope to be able to tackle. Anything else that you submit during the webinar today, we're going to save for our next webinar, which is going to be almost exclusively an Ask Me Anything type of a webinar, and it'll be just ahead of the tax deadline. So, it wouldn't be too surprising if many of the questions that were posed were actually tax questions, but of course, feel free to address anything that you'd like. So again, thank you very much for the questions that have already been submitted. And I don't hold back on submitting some more, but we probably will hold on to those and address them in the next webinar. So for anyone who hasn't attended one of my webinars before or spoken to me directly, just by way of introduction, I'm Monique Madan, and I'm a certified financial planning professional, a financial management advisor, and a chartered financial divorce specialist. I've been in the area of personal finance for about 2 decades, but my background is actually in psychology. So while I don't profess by any stretch of the imagination to be anything like a practitioner of psychology, I will say that it probably does lend itself to the way that I practice wealth management. And the way it does is that I actually see wealth as being accumulated for a purpose. So in my client engagements, I tend to take a lot of time to learn about why it is that you've accumulated your wealth and what you're trying to accomplish. It's only after I get a real sense of that that I spend some time doing analyses and sort of the dry mathematical behind the scenes work to try to get, suggest strategies that might help you get to those goals. Now, while I don't think I've ever come across someone whose goal it is to pay more tax, and I've certainly met lots of people who have opinions about where our tax dollars are going, I can actually say that I think controlling the amount of tax that we pay is probably as close to a universal goal as I've ever come across. Now, besides, the truth is there's so much these days that's outside of our control. I like to use tax planning as a way of helping clients exert control over something about their future. And that's what we're going to discuss today. Professionally speaking, I'm the head of financial life strategies at UPotential and ETF Capital Management. UPotential is a fee-for-service financial planning firm, meaning that I don't sell any products whatsoever. And what we do is we focus on unbiased advice and strategy. And UPotential is available to anyone, regardless of who they work with for their investment advice. Now, I'm also extremely lucky to be working with Larry Berman's private client group at ETF Capital Management. These clients get the exact same unbiased service as the UPotential clients get, but of course it's coupled with best-in-class investment advice. So today we're going to focus on tax planning. And as I mentioned in the invitation to this webinar, tax planning really is best done proactively, where you structure your financial affairs in a tax efficient way. And this is far superior to trying to scramble to implement a strategy, in advance of the tax deadline. Reporting the taxes for the 2020 year, as I mentioned, is going to be pretty different for a lot of Canadians because such a large swath of our population received some sort of income interruption, whether it was a furlough or a drop in income. So we're going to start off with a short update of some COVID-related issues still lingering from the 2019 tax reporting year, and to discuss some of the hot button topics, including the work from home deduction that is going to be commonplace this year. Next, we're going to focus on supporting those of you who may be reporting self-employment income for the first time. Then, we're going to discuss some ways in which you can harness any fluctuations in your tax bracket to your advantage. And finally, if time permits, I'll touch upon how charitable giving can provide a valuable tax benefit, and especially for those with higher incomes in retirement who don't have, let's say, RSP contributions to help control their taxes payable. If we don't get to this particular topic because of time constraints, I'm hoping to do a whole separate webinar on charitable giving. So without further ado, let's get into the meat of the matter and start with some pandemic-related tax planning. Now, you may recall that the tax deadlines for the 2019 reporting year were extended and extended again. This year, don't get comfortable with the idea that there will be any extensions. There's, to date, only been one extension announced, which I'll get to in a minute. Before we discuss the exceptions, though, let's just confirm the rules. There are two important deadlines, one for filing your tax return and one for paying the outstanding balance. Everyone, and I mean everyone, must respect the tax filing deadline of the 30th of April 2021, with penalties levied if you file your taxes late. The tax payment deadline is actually the same date, but there has been an extension allowed and announced recently, specifically for Canadians who are in sort of the low to middle income area and also received pandemic relief of some sort. So if your income that you're reporting for 2020 is less than $75,000 this year, and you received some sort of COVID-related relief, whether it was in the form of one of the CERB benefits or employment insurance, you will be able to actually remit the amount outstanding in 2022. You still have to file on time, but I gather that it's going to essentially be very welcome news to anyone who would find it difficult because of unstable income or lower income than usual to remit their full taxes this year. There's some extra time to do so and hopefully see your income stabilize during that time. Now, the penalties associated with our tax season are twofold. First, there's a late filing fee, which is essentially 5% of the taxes outstanding and a 1% penalty of that amount for every additional month that it's late. So if you owe taxes, there is a late filing fee that can run up pretty quickly. Similarly, if you owe taxes, there is an interest payment on what's outstanding. And that is calculated at 5% per year, but get this, it's compounded daily. So that could really increase quickly. Again, no one is immune from the late filing fee unless, of course, you don't pay taxes or money is owed to you. So if you file a null return or return that provides you with some sort of a refund, you would not have to pay a late filing fee, but why wait? Why not get the money that you're entitled to? So please, please, please try to remit your tax return on time. Remember also that filing on time also makes sure that any benefits that you're entitled to beyond your refund, something like the Canada Child Benefit, won't be interrupted. Now, you may also recall that there was an awful lot of confusion early in the pandemic with respect to who would be entitled to various relief payments. We would have liked to have had greater clarity on the front end, but I gather, it was probably more important to get money into the hands of Canadians. So now we're kind of grappling with sometimes errors in having applied for the benefit when we weren't entitled to it. So rather than slow down the financial stimulus, now we're in a position where we may have to repay our CERB benefit if we collected it incorrectly. By this point, if you received the CERB benefit or EI in 2020, you should have received a tax slip CRA issued tax slips that were called T4As, and Service Canada issued tax slips called T4Es. Now, if you were also part of the swath that had to repay some of these benefits, your repayment should have been reflected on your T4A or your T4E. If it didn't, CRA is asking you to contact them so that they can track the payment. Now, you're not in any trouble. You can still prove that you remitted the payment using your bank statement, but CRA has acknowledged by sheer volume of the monies that were coming back and forth that some of these payments might have been accidentally applied to, let's say, arrear payments from previous years, or to those who might be in the quarterly installment regimen. It might have incorrectly been applied to your quarterly installment. So they are asking that you get in touch with them, and they'll go look for tracking the payment. Now, here's really the hot topic of this year, which is the home office expense for employees deduction. Before we get into the new simplified options, it's important to distinguish between the deduction that's used if your home is your normal place of business, normally where you would see clients or customers or patients, or if you're primarily working from home as a result of the pandemic. The major difference is that those who normally work from home are entitled to, among other things, to claim the property taxes that they pay, get some benefit on the mortgage interest that they pay, and an accounting term called capital cost allowance, which is related to the depreciation on their home. They use something called a business use of home deduction, and that entitles them to those enhanced benefits. If you're self-employed or your employer has never provided you with a place of work, then you're probably already aware of the business use of home system. If you're not, I've included a link in the resources section at the end of the webinar, and I would certainly recommend that you speak with your accountant. So in contrast to the business use of home deduction for the self-employed is something called the home office expense deduction. The primary difference is that the home office expense deduction is for T4 employees whose employers require them to maintain a home office. In fact, the employer actually has to fill out a form called a T2200, enabling the employee to claim home office expenses. And it's this deduction that was expanded upon and simplified due to, again, the just sheer vast numbers of employees who relocated as a result of the pandemic. Now, you can claim this deduction in one of two ways. There's a simplified option, which is a flat rate for each day that you worked from home and really doesn't require anything fancy. No documentation, no forms for your employer to complete, simply, an accounting of the number of days that you worked from home. Then there's a detailed method which requires a lengthier calculation that first actually prorates the deduction based on the square footage of your home as it relates to the square footage that was actually used as a workplace. Second, it requires you to maintain backup documentation in case you were ever called upon to submit it. And thirdly, requires that your employer complete a simplified version of that form I told you about before, something called the T2200S. Now, in some cases, the detailed method could yield a larger deduction, but you might be surprised that it's not as commonplace as you might think. To qualify for the flat rate, you have to have worked from home for more than 50% of the time for 4 consecutive weeks. And that allows you to get a $2 per day deduction with a maximum of $400, which of course represents 200 work days. Now, one thing that hasn't been well talked about is that this actually excludes vacation and sick days. So 200 work days is roughly the equivalent of 10 months. If you are amongst those who transitioned to working from home pretty quickly and early on in the pandemic, then it's probably feasible you might reach this maximum, the $400. Now, I've run some scenarios as it relates to the flat rate benefit, and it actually kind of approximates what you might be able to claim in the detailed method if you own your home. But if you rent, and especially for renters in large urban areas where, let's say, the rental units are smaller or the rent is very high, the detailed method could easily yield a larger deduction. Now, here's a situation where the Canada Revenue Agency has actually created a spectacular tool that can walk you through the process to determine for yourself whether, it's worth the rigmarole of going through a detailed calculation. And I've included that link in the resources section at the end of the presentation. Incidentally, a lot of people find that they've been using shared spaces like kitchen tables or dining room tables, and those spaces actually have multiple uses. They're your workplace for the pandemic, they're home spaces, and they've even been classrooms for children. So the detailed calculation actually requires you, if you don't have a dedicated workspace, to prorate the hours of the day that you use those spaces for work, which could mean that, it'll put even more pressure on that detailed calculation because you'll only be able to use, your dining room table maybe 8 out of 24 hours or a third of your day. So again, while I would encourage you to explore the detailed calculation, and especially using that great tool that CRA has created, I'd be surprised if, especially if you own your home and the detailed calculation actually yields a better deduction for you than the flat rate deduction. Now, as time passes, more and more questions come up, and we're slowly getting clarity on these subjects. Remember, we've never faced these things before. For example, I delivered a webinar just 2 weeks ago, and the following questions came up that we didn't have answers to then, and we've since found answers to. So I thought I would share them with you. One of the questions was related to spouses who are both primarily working from home. In other words, can both spouses claim the home office expense deduction? And the answer is yes. Each spouse can use either the detailed calculation or the flat rate on his or her income tax return separately, effectively doubling the benefit for the household. Another question related to the setup costs of setting up a home office, purchasing perhaps a desk or a chair, things like that. And this kind of surprised me. Lots of office expenses, including things like stationaries and whatnot, are included in the deduction calculation, but for whatever reason, furniture is not. And I think this is a bit curious, so I wonder if this is not going to evolve. But the best available information to me right now has furniture being specifically excluded from the calculation. And naturally, if you've been reimbursed by your employer, you wouldn't be able to claim any deduction for the setup costs for your home office. Thirdly, with regards to those who are living in condos, if you're going to try the detailed method of calculating the deduction, you're going to need to estimate the utilities that pertain to your condo. And for those who don't have separate utility fees, those are included in condo fees. Now, how do you determine the proportion of the condo fees that are related to utilities? Well, if you want, you can look at the condominium's financial statements and then prorate it, or you simply email your property manager who will give you some guidance as to what proportion of your condo fees are related to utilities. And I can promise you that property managers will be fielding this question very, very frequently, so don't be bashful about asking. Now, I can probably speak for everyone when I say that we would all like to put 2020 behind us, but 2020 is still going to linger on beyond the continued health risks. In fact, employment for Canadians, for some of us might end up permanently changed. And this might include those who have been propelled into self-employment when they never were before. So I want to give some guidance to those who are perhaps reporting self-employment income for the first time. Now, in the past, I have been self-employed, and to some degree, I still am. And I can tell you that it is immensely satisfying and at the same time, absolutely terrifying, simply because so much of the responsibility lies squarely on your shoulders. Through the pandemic, of course, lots of people have been forced into self-employment, either because their jobs were furloughed or their employment income dropped dramatically. Now, at the same time, self employment provides you with some amazing control over your financial situation, including the power to decide what kind of work you accept, what type of income you're collecting, and when you want to declare it. Now, interestingly, this also pertains to many clients in their early retirement phase, especially for those who are easing into retirement by reducing, let's say, their work week or cherry picking the projects that they accept. Now, some clients anecdotally tell me that they select projects because, let's say, they're lucrative, or because the project fits in their travel schedule, or even some, will choose a project deliberately because it includes travel expenses. And of course, there's lots and lots of research that shows continued social benefits of staying active through self-employment, especially given how long our retirements can last. But self-employment is not itself without drawbacks. Until recently, of course, few self-employed people had any income protections if their income dropped. Until recently, for example, self-employed people could only participate in the employment insurance benefits to the degree that they were providing themselves with parental leave or maternity leave. Of course, this was expanded upon dramatically over the pandemic, where SERP was actually extended to the self-employed as well, but we don't know if that's going to continue. So if you found yourself self-employed, suddenly, please be organized about your record keeping. You have to account for all of your income, but also all the costs of doing business. And this relates back to what we were just talking about in relation to the business use of home deduction. Obviously, it's a complicated calculation. And if you are particularly organized in your record keeping, it's going to help you quite considerably. And of course, a business is not only accountable to its customers, but you're accountable to your employees and their families too, meaning that the self-employed are often under a lot of stress and stresses that people who are employed may never, fully appreciate. So for those of you who are new to self-employment, there are a few things you should be aware of. Firstly, if you provide a good or a service and your sales exceed $30,000 a year, you should be charging some sort of sales tax. Now, depending on your province of residence, this could be in the form of either GST or HST. Now, it may seem obvious that GST and HST that you collect is not income you can spend. But I can tell you that many, many clients over the years have found themselves needing to dip into their GST or HST reserve because their revenue dropped. Now, I can promise you this. No one does this deliberately. We all know that we're collecting this money on behalf of the government. The issue simply is when you're self-employed, and especially early on in your business, it's really hard to determine whether a sales slump is temporary or if it's permanent. And so if you find yourself in this predicament, dipping into your GST or HST reserve to meet expenses, please contact your accountant and ask for help in negotiating some sort of an HST or GST remittance schedule with CRA. You'll also find over time that you may be able to determine seasonal patterns to your sales that can help you adjust your personal salary and your inventory accordingly. Secondly, it's very important for you to segregate your business income and expenses from your personal income and expenses. Now, this can be done super easily by opening a separate bank account and ensuring that all of your business income and all of your business expenses are processed through that account. Over time, the business could actually become eligible for, let's say, a credit card or a loan based on its creditworthiness. But don't be surprised if you yourself have poor credit, your creditworthiness can sometimes become relevant even to your business. So you're going to want to do this as cleanly as possible and protect the creditworthiness of your business venture. One note of caution, by the way, when it comes to business expenses, some people, won't name names, can go overboard with regards to business spending because they kind of think that everything's a write-off. The idea of a write-off is often misunderstood. You only get a write-off or a deduction against actual income that you're making. So if you're not making any income, the write-off is kind of useless. The most common mistakes are made with meals and entertainment. You remember when those were possible, and specifically car expenses. In many, many cases, the tax advantages related to these particular expenditures are not nearly as good as you think they are. When it comes to incorporating your business, I could talk about this for hours, and maybe one day I will. But for the purposes of our discussion today, suffice it to say that incorporating really does provide the best advantages of self-employment that I, mentioned before, but also does require additional accounting in the form of a very complicated and sometimes costly corporate tax return. To determine whether you should incorporate or not, start with the level of profitability of the business. If you're investing money into the business, but not yet turning a profit, it's likely that you should run the business as a sole proprietor because any losses in that business can be deducted against income that you have from other sources. So let's say this is a job that you have on the side. If you're investing in that business, but you have full-time work aside from that, you can use those losses to reduce the taxes payable on your other employment income. If, on the other hand, the business is profitable, then, and especially, by the way, if you can leave money in the business, meaning that you don't need all of the profits to cover your own expenses, that is a great indication that you should be incorporating. So if you're at all unsure, best to talk to your accountant. And on the topic of incorporated businesses, a business owner has complete control over how much he or she gets paid and whether that income is in the form of a salary, kind of because they're wearing the hat of an employee, or in the form of dividends, kind of because they're wearing the hat of an owner, or, as is often the case, a combination of the two, because dividends do offer a slight tax benefit. And dividends do not require you to contribute to the Canada Pension Plan. Now, admittedly, CPP premiums are pretty heavy these days. So I do appreciate why self-employed people do want to participate in dividends to some degree, and especially because if you're self-employed, you need to contribute both the employer and employee portions of the CPP premiums. But I have to tell you that I've seen many, many clients kick themselves for this decision at retirement when they realize that they're not eligible for a valuable, predictable, and inflation-adjusted retirement pension. So, if you're relying primarily on dividend income, please meet with your financial planner or your accountant and look at projecting what sort of income you're going to have in retirement to ensure that you're saving to make up for the fact that you're not entitled to CPP. I once did a calculation on this, by the way, and it shouldn't surprise you. It could require you to save in excess of another $250,000 or $300,000 just to make up for your lost CPP. You should also check if you have disability insurance. Not all disability insurance policies will recognize dividends as employment earnings. So you want to be very, very careful there. The next topic I actually alluded to in our last webinar when we were discussing RSP contributions and the deadline. Monitoring your marginal tax rate is really important. What I'm about to show you will resonate for those of you who have worked with me previously, because I often will talk about aiming for a particular tax bracket when you have some control over the amount and the nature of the income that you collect. This type of tax planning is important for actually a wide range of individuals. So if you fall into any of the following categories, listen closely. Small business owners who can control their annual salary dividend mix can easily elect to earn a salary up to, let's say, a certain point, which often will hover around the RSP contribution threshold or a particular tax bracket. And then if they need any extra money, they'll take it in the form of dividends. Similarly, for employees of large corporations who, let's say, have employee share purchase plans, they can often accumulate large swaths of their employer's stock, and of course, they can control when they sell those stocks. And lastly, retirees who are drawing from large RIFs or LIFs often find themselves in high tax brackets and may wish to exert some control over how they access amounts that they might need. We call this tax effective harvesting of your income. For these individuals in particular, this kind of tax planning has the added benefit of potentially preserving your old age security from the clawback. So clearly there's lots of reasons to monitor your marginal tax rate. When I'm doing tax planning with clients, I will usually reference a provincial tax table like the one I'll show you here for Alberta. And this helps clients make strategic decisions with respect to the amount of income to claim in the current year, and especially when they have some control over maybe deferring income to a future year. Now, before I go any further, let me clarify what a marginal tax rate is, because that's important here. Canada has a progressive tax system, so our total income is broken down by tax brackets like the ones you see here. For Alberta, for example, the first $49,020 in regular income. So this would be income from employment or income from your RSP or, any standard income that's not tax efficient would fall under the other income column there, which as you can see in the lowest tax bracket is 25%. The next $49,020 in that same column is subject to 30% and a half, and so on. Now, if you live in a different province, your tables will be a little bit different, but you do get the picture. The marginal tax rate is the highest tax bracket that you inhabit in a particular year. And it becomes important because any sort of other income that happens in the year, whether it's the sale of a property or investment income in a non-registered account, is always taxed at your highest level or the highest tax bracket that you inhabit. In other words, your marginal tax rate. So let's use a couple of examples. Imagine for a minute that you are planning on retiring at the beginning of next year, and you currently earn $150,000. That brings you, let's say, to the 38% tax bracket as your marginal tax rate. If you, again, earning $150,000 in the year, also are thinking of selling a retirement property, a rental property that you own, and that rental property is in a position of a capital gain, if you sell that property this year, it's going to easily push you into paying in excess of 40% rather on the taxable capital gain. But if you are intending to retire next year and anticipating that your income is going to fall, if you can just wait that 1 year, which, realistically, we're in the middle of March, is really only 8.5 months away until January, which is a brand new tax year with brand new deductions and credits, you could be paying the capital gains taxes at a far lower rate, especially if you're not yet going to be withdrawing from your RIFs. Similarly, let's say you're again earning at about $150,000 a year, and you're in that situation I referred to before where you have a large collection of stock in your employer. If you sell some of the stock this year, you're going to be paying capital gains tax at, again, a higher tax bracket, 38 or 41.32 or above. But if you're close to retirement and you can carry those shares into your retirement, meaning there's no prohibition in you continuing to hold your employer's stock after you retire, if you just wait those 8.5 months, it's perfectly conceivable that in January 2022, you might be in a lower tax bracket, meaning you'll pay less on those capital gains. Now, this becomes a little bit trickier because publicly traded stocks, of course, are volatile. So while we do want to control the tax, we don't want to make the stock vulnerable to, let's say, a share loss. Let's say there's some pressure on the stock or the markets start to tumble. In this particular case, we would add investment protocols to our discussion to protect your capital gain. And these might be in the form of stop losses, if you've heard of those before, or income or options rather. These protocols will help protect the capital gain and help you tide over until January of 2022. And what about a retiree, for example, who has a large RIF and wants to take her family on a family vacation? So again, rather than withdrawing additional sums from the RIF, being paying taxes at a high rate and potentially subjecting your OAS to the clawback, I might encourage this person to withdraw from their TFSA to supplement their RIF withdrawals, because any amounts withdrawn from the TFSA are not subject to the OAS clawback and of course are not taxable. So you can see that there's lots and lots of ways that you can benefit by keeping an eye on your marginal tax rate. Now, to be clear, the goal isn't always to pay as little as possible every year. The goal is to make good decisions for the current year and then position your household to minimize taxes payable over your lifetime. So, for example, this graph shows an individual's yearly tax rate throughout their life. And again, anyone who's worked with me will have seen something very much like this because I just love this graph. Each of the bars, the black bars, represents the amount of income that was payable in tax in a particular year. So if you see at the far left, this was produced in 2020. This particular gentleman was subject to, let's say that's an 11% tax bracket. The bar reaches up to 11% directly above 2020. In 2021, it was roughly the same. 22, it starts notching up, and 23 in this person's situation is actually the first full year of RIF withdrawals, and they're already at, let's say, a 19% tax bracket. So this is how this works. If you fast forward, let's say, to the end of the table on the far right-hand side, you see that those bars start to spike. Somewhere around, what is that, 2055 rather. This happens because this particular client is projected to outlive his spouse. In other words, there's no longer anyone this person can income split with. All income produced by the household falls upon his shoulders. So the question then becomes, what can be done in this year, next year, and let's say the near future to put this particular person in the best footing possible to pay less tax over the course of their lifetime? So some of the strategies that we worked through together included converting this gentleman's RSP to a RIF early, so before it became mandatory in 2023. If I highlight the section on the far left for you, let's say, the graph on top is the before version. The graph on the bottom is the after version. And you can see what we noticed before, that kind of step up pattern in the top version becomes leveled off in the bottom version. And why is that? Because in this particular case, withdrawing from your RSP sooner allows the client to prepay tax at a lower rate. Funny enough, my calculations showed that just this little change resulted in a $9,000 savings in their tax situation. Fast forward the same situation on the tail end, on the far right-hand side, it's a little bit subtle, but if you take a look and you just look up top and then compare it to the bottom, you'll see that those black bars are actually quite a bit lower in the bottom graph. And that shows you the compound effect of having prepaid some tax early. So the goal isn't always to pay as little as possible in any particular year, but instead to achieve your goals and control the amount of tax that you pay over your lifetime. Now, it looks like we are going to have time for charitable giving, and that thrills me because I love to talk about charitable giving as a tax strategy. Um, Now, it's interesting, the government tends to promote or reward certain things based on tax initiatives. So, for example, to encourage people to, let's say, invest in businesses, the government allows you to deduct interest paid on loans that are used to invest, whether you're investing in your own business or investing in a portfolio. Similarly, the government rewards charitable giving using the donation tax credit, which is amongst the more generous tax credits that we have. Now, I spent my formative years of my career at the Hospital for Sick Children Foundation in Toronto, where I was in the estates department and I did some work in tax effective charitable giving. And I got to tell you, I loved every minute of it. I loved learning what inspired the gifts and helping clients to make bigger gifts that were tax efficient. So I am just tickled every time I can use this with clients. Now, just a refresher on the the donation tax credit. The first $200 that's donated is credited at the lowest federal tax rate, but anything exceeding that is credited at the highest federal tax rate. So one of the more commonly understood benefits of this is if you are in a partnership or you have a spouse, pooling your donations with your spouse will make sure that you don't get caught using that lower tax rate twice. But of course, there are limits on the amount that you can apply as a donation credit in a particular year. Normally, that limit is set at 75% of your net income. But for sort of unusually large gifts, what we call transformational gifts, maybe once in a lifetime gifts, anything that you couldn't use in that year because it exceeds the 75% of taxable income can be carried forward to continue that benefit for up to 5 more years. Similarly, sometimes the largest gifts people make are through their estates, and the donation credit can be used in that year actually to wipe out any taxes payable by your terminal return. That can be incredibly helpful because, of course, everything that hasn't been taxed in your lifetime is all taxed on your terminal return. And that can include, anything that's left in your RIF, that's often very heavily taxed, any capital gains that you haven't previously crystallized, etc. So you can imagine that donations can be incredibly effective at controlling taxes in that year. And if the gift is too much, meaning you've already brought your taxable income to zero on the terminal return, you can actually report some in the preceding year, the year before death. Of course, it wouldn't be you, it would be your representative. Now, donations exceeding $200 used to always be credited at 29% across the country, federally that is. But now we have a higher federal marginal tax rate of 33%. So what has happened is the donation credits to those people who actually pay tax at 33% will be credited at 33% to the degree that you have income at that level. That really just applies to those with exceedingly high incomes of $220,000 or more. Now, this again translates into some savings on the provincial end too, because provincial tax rates also apply, and some provinces have extra high provincial tax rates. So here's a table that references the provinces and a link that would allow you to, double check where your donation would fall will also be included in the resources slide. Now, if you've worked with me, you'll probably know that I love the idea of using non-registered assets, which typically add to your tax burden every year, to make either RSP contributions or TFSA contributions. What this does is it controls the amount of tax payable on investment income on a year-to-year basis. But donations can be thought of the same way, especially when it comes to donations of publicly traded securities. If you have publicly traded shares that have appreciated dramatically and you donate those shares in kind, meaning in share form without selling them, you simply donate the shares themselves to a registered charity, you'll get a donation credit for the fair market value of your donation. But here's the kicker: you don't have to recognize the capital gain on your taxes. So you actually get an enhanced benefit. Technically speaking, this is called, a capital gains inclusion rate for donations of appreciated securities is 0%. That's incredible. I saw a lot of these when I was at the Hospital for Sick Children Foundation. The rules were slightly different, but for clients who were getting Nortel, if you remember that debacle, they were getting Nortel as a spinoff of their BCE shares, but were uncomfortable with tech stocks. People were donating them hand over fist and getting amazing benefits. Although, like I said, the rules were slightly different back then. Now, I hope to focus an entire webinar on creative ways to optimize your charitable giving, where we'll discuss other things like donations of life insurance policies or naming a charity as the beneficiary of your RSP or RIF, but we'll deal with that in due course. Now, some questions that we can talk about today. Oh, there's the second one. So in preparation for this webinar, you'll remember that we issued a call for questions from the audience, and here are two that might be of interest to you. And of course, please continue to send these questions, because next month's webinar will include all the questions that we've collected today and any that we collect, within a reasonable period of time. The first one has to do with dividends issued by publicly traded stocks and their effect on the old age security clawback. So this is actually a great question. Very often people will load their dividends into their non-registered accounts because they are tax efficient. Again, that gross up and tax credit scheme that we talked about before. But it's also incredibly likely that that could push your taxable income beyond the OAS threshold, because the threshold calculation is made on the amount after it's grossed up. So I actually did a quick calculation. Let's say you have $60,000 in dividends in a non-registered account, all from Canadian source companies. Grossed up, that's going to be $82,000, because the gross up is 38%. $82,000 already brings you into the OAS clawback threshold, and we haven't talked about any other sources of income yet. So yes, the answer to this question is yes, the dividend gross up most certainly can push you into the clawback threshold. And unfortunately, the credit doesn't come into play until after the calculation of the clawback. So what's a person to do? Well, if you're facing this situation, a couple of remedies could be splitting retirement income pensions with a spouse. That could help control the other sources of income that your dividends would be added to for the purpose of the calculation, and especially if your spouse is in a lower tax bracket. Just remember, if you split any income, you could be pushing your spouse into the OAS clawback threshold. So you want to be doing this very carefully and strategically. Another possible remedy could be putting your dividend producing investments in your TFSA, where the gross up isn't an issue, and withdrawing monies from the account is not an issue with regards to the OAS clawback. You can extract as much or as little as you want at no tax consequence. If you're going to be doing this, remember, if you put the assets into your tax-free savings account, you will have to pay tax on any accrued capital gains, anything that's crystallized up to the date of transfer. This is whether or not you contribute the shares themselves, in other words, in kind, as I mentioned earlier, or you sell them and put them into the account. Either way, it's what's called a taxable event. But at least that would be a taxable event that happened once. Dividends are wonderful in that, at least in the foreseeable future, they will continue until the dividend is changed for whatever reason. So it might be the difference between losing all or part of your OAS in a single year versus a continued issue year after year. The second question that was posed also related to dividends, but produced by U.S. stocks, because U.S. stocks are subjected to a withholding tax of 15%. So the person who was asking the question asked, how could I avoid or reduce these withholding taxes because they actually impede my investment return? For this particular question, I would suggest that you put your U.S. dividend producing stocks in your RSP rather than your tax-free savings account. When U.S. stocks that produce dividends are in an RSP, no withholding tax is levied. So you enjoy the full dividend as opposed to sacrificing a portion of it to the IRS. The disadvantages, of course, to putting dividend producing stocks in your RSP is that you don't get any sort of tax benefit. The RSP is completely agnostic when it comes to the nature of the income within the account. And of course, when you take the money out, you're not going to have any issues with regards to enjoying any sort of a dividend benefit, because every dollar taken out, whether it was originally a capital gain or a dividend or interest, is all taxed in the same way. So, putting them in the RSP would actually be a great thing. You get the full flavor of the benefit of the dividend, but you don't have to sacrifice any of the withholding taxes. Now, just keep in mind, by the way, that if you're holding dividend paying stocks in any denomination in your RSP, do that because of the yield. What I'm hearing often is that people are using what they see as stable dividend producing stocks in place of some fixed income positions temporarily. There's not the same risk profile, of course. A dividend stock will always be a little bit more risky than something that produces interest by nature of the asset itself. It's an investment rather than a loan, but very often right now, because of very poor interest rates, people are deciding to push the limits just a smidge and participate in some, like I said, more stable sounding dividend producing stocks to supplement their normal fixed income positions. So again, do so because of yield or because you need a particular asset allocation, not because you believe it's going to produce any sort of tax advantage, because again, US stocks don't do that. With regards to having US stocks in TFSAs, by the way, they don't get the same treatment. The IRS does not know what to do with a TFSA. They do not recognize it yet as a tax efficient account. So, you will continue to have to pay for withholding taxes. And if you're a US citizen in particular, don't participate in TFSAs because, again, the US does not know what to do with them. So again, thanks everyone for submitting your questions. Please, I hope there's many, many more to discuss next month. So in summary for today, there are many ways in which the pandemic is continuing to influence our lives, and it will influence our tax reporting. And these are including, let's say, that very limited remittance extension that I mentioned earlier, the use of the home office expense deduction, and the fact that some people are going to be reporting self-employment income for the first time. Beyond the current year, there are great ways in which we can control the amount of tax that we pay by strategically taking advantage of year-to-year fluctuations in our income. and by making charitable donations. So as I mentioned, our next webinar is going to be a great opportunity to really ask me anything. I think we've slated it for April the 20th in the afternoon, Eastern Time. And please, if you're going to be remitting questions, like I said, we're going to hold on to anything that was remitted today. You can continue to submit questions either through a button that's going to be available on the survey accompanying this webinar, or by emailing me at monique@upotential.com. And if you could submit those questions by April 9th, that'll give me lots of time to investigate them if I need to and come up with good, juicy answers for you. If you're at all shy, please keep in mind, like I did today, I'll respect your privacy. I won't use names, and I'll try to answer the question as robustly as I can. But I promise you, if there's a question that you have nagging in your mind, I can promise you other people have similar questions as well. So for now, thank you so much for your time and attention today. A recorded version of this webinar is going to be made available soon. And please, as I always say, if I can be of any service, please don't hesitate to contact me. It would be my pleasure to help in any way that I can. Thanks for joining.